What's up everyone, Dylan here. I wanted to hop on for another episode of the weekly analysis video. I'll try my best to keep it short and sweet, so with that said, we'll hop right into it. The most important event of the week is Friday morning, which is the NFP jobs report. Last week I said that it's very, very important to keep a close eye on the Fed Watch tool via the CME Group website. And as of this moment, there's a 91.7% chance that the Fed cuts rates at the September 17th meeting. Okay? As we get closer from now to September 17th, economic events are going to have much, much more influence. Okay? And essentially, they can change the trajectory of what that percentage is. The higher that percentage is, the more of a relief it is for the overall market. However, the lower that percentage gets, it will result in a little bit of a headwind for the market, aka more of a bearish piece of context. Okay, last week's video I talked about how the month of September is usually a weak month, right? I showed you guys a heat map quilt. This is another visual right here. It's more of a histogram, very, very simple, right? The average SPX return by month since 1928, it is very, very clear that September is the weakest month with an average loss of 1.17%. Okay, here's another visual, right? This is from Ryan Dietrich, I believe, right? He writes, when the S&P 500 in August closes up more than 1%, and there's at least 5 all-time highs that are made, the following month of September has never been higher. Okay, you could see all the way back to 1961, he writes, all of the August returns, all of the all-time highs that were made, right, respectively, and then as you could see, the average September return for these types of months, right, that hit those criteria is 2.3% to the downside. Okay, will that happen? No one knows. That's just another piece of context that points to September being a tough month for equities. Okay, there's another thing. When the S&P 500 closes August at an all-time high, the index has closed red for the month of September 14 out of 18 times for average losses of 1.6%. That's from Steve Depp. Depp. Okay, that's via Twitter. Okay, another thing from Kevin Malone. Out of the top 200 insider trades over the last week by value, 0 out of 200 were buy orders. I have never seen anything like this in my life, quote unquote. Okay, so again, these are all pieces of bearish context. However, not to make anyone upset, I'm also going to talk about some bullish pieces of context as well. And then at the end of this video, I will basically give you guys a line in the sand that I am personally using to gauge whether bulls or bears are in control. Okay. Another thing is the fact that CTA positioning in US equities officially sits at the 100th percentile and is maxed out. Okay. While not an active headwind to equities, this means that there will be a less supportive flow in a historically weak month, which overall, that's technically it's not necessarily an active headwind, but losing that extra piece of support certainly isn't a great thing for the bulls. Okay, so that's another thing. Also, CTAs will have to sell $70 billion over the next month in a down tape, as per Goldman Sachs estimates. Okay. Another thing is the fact that a lot of people have been looking at this head and shoulders pattern on the NASDAQ. You could see if we go ahead and where's the shapes right here? If we go ahead and show you guys, right, that's the left shoulder. you have the head and then the right shoulder here, right? That's a pretty clean head and shoulders pattern, right? I can't sit here and say that I don't see it because it's very clear that I do. The neckline would be right around here, which you could see got respected very, very well today. Okay, so stemming from July 2nd, this is my own opinion on the neckline. Some people have been putting the neckline here, and then other people have been putting the neckline here as well. So whatever floats your boat, I believe that that black trend line gives you the best sense or the best gauge per se because it has the most tests and it's the closest and it respected very, very well today. So I think that it's a very, very good gauge. Okay, that currently sits right around 23,035-ish. But as time progresses, that level will get higher and higher as it is an ascending line. Okay, so again, will this breach and continue to the downside? Maybe, right? Again, I'm going to talk about the line in the sand that I am personally using. Another thing, I don't have a screenshot of it. I used to, but I don't know where it went. NASDAQ, and I talked about this last week, NASDAQ and VIX are very, very lopsided positioning. There's a large NASDAQ positioning from the long side, and then the VIX has a very, very lopsided positioning on the short side. So any quick violent move to the downside can exacerbate that move because of the lopsided positioning. Okay, that's another thing. So let's get into some bullish pieces of context because it's very, very important to have an open mind in the market each and every day, right? Anyone who sees that September is usually a red month, right, is going to be more, tempted to basically put on a blindfold at the start of the month, buy puts, and then hope for the best, right? That could work, don't get me wrong, but if you do that every single time, there's really not much edge in doing so in a blind manner, okay? Instead, you should be looking at context to confirm your thesis, okay? So this is from Goldman Sachs today, right? They said, quote unquote, I think that if indeed a correction happens, it will be shallow and quick because of 5 reasons. A, most investors are still long-term bullish. B, everyone knows about the bad seasonality in September, right? Basically, it's a crowded trade. Usually, when things are crowded, the opposite tends to occur because it's the path of least resistance. I am a big believer of that. The third one is fundamental investors already de-risked in August ahead of this seasonality event. Fourth one, positioning is still somewhat light. We've had 25 straight weeks of negative sentiment reading. And then the fifth reason is because of positive gamma. We estimate that dealers are long gamma, which will keep the market range bound at the index level. The 10-day change in dealer gamma positioning is the largest increase in our history at a positive rate of $10.9 billion. The current gamma pocket acts as a market buffer. Basically, the higher the gamma is, the less volatile. Okay. On the flip side, when you have an S&P environment in negative gamma, that exacerbates the move where you usually have more continuation, more swings, right? More volatility. So they're saying that the positive gamma environment is going to basically be a support, increase the supportive flows of any pullbacks that occur. Right. So I thought this was interesting. And again, I do agree with their aspect of the fact that the crowded trade is the fact that there's bad seasonality in September. So Dylan, you've given us tons of bearish information and a bit of bullish information as well. How does that help us? Right. So let me get into it. So the line in the sand that I am using is SOX 5475. Okay, very, very simply put, 5475. Okay, in the Discord I wrote that there's a line that I have, right? I say where SOX goes, stocks go, right? SOX is very, very influential, right? The semiconductor index, right? Semiconductors as a whole are a very, very high beta sector, meaning if they make a large move up or down, chances are the NASDAQ is going to follow suit and move in tandem. So 54.75, you could see on this chart, has multiple areas of support, right? It's bounced there, 3, 4, 5 different times. No, it has not been perfect. As you could see, it's gotten below that, but it has not had a daily close below. So up until there is a daily close below there, I can't see much continuation on the downside in the S&P and the NASDAQ. Okay, that's very, very clearly put, okay? If and when that breaches to the downside and stays below, right, where sellers reject, pops, back into it, right, where that area of previous support then turns into resistance, then I could see that the S&P and the NASDAQ will have some continuation to the downside. But up until that happens, the bulls are in control. Hopefully that's very, very clear. If and when SOX gets below 5475 and stays beneath, the VIX 1895 to 1905 is going to be very, very important. This was previous support, which then turned into resistance. So if and when SOX gets down to 54.75 and breaches and stays beneath, the bears want to see that the VIX can get above that area of resistance and stay above. So if those two things happen with SOX below that support level and VIX above 1905 and have the ability for both to stay SOX beneath and VIX above, that would set up for the highest likelihood that the S&P and the NASDAQ will continue to the downside, where you'll see multi-day, multi-week declines, and the September seasonality will basically come into fruition. Okay, so up until SOX gets below that, will the bulls remain in control? Hopefully that is helpful. The other thing is a key area of support on the US 500. US 500 is just the SPX with extended hours. So the 50-day moving average lines up with this area of support. Okay, so that's going to be a very, very key area of support going forward, which basically lines up with S&P right here, S&P level right here, double bottomed a couple weeks ago, 63.64. So that's going to be the very, very important downside area to keep an eye on, because that's going to test before SOX gets down to that support, the line in the sand. So ideally, S&P bulls need to defend there, and if not, if that breaches, SOX should or could probably get down, or should likely get down to the line in the sand level. Okay, so hopefully this video was simple and easy to read, and I will talk to you guys soon. Peace.